Welcome to this session on control accounts. This is an area which is highly examinable in the F3 ACCA paper, as well as the FA2 and part of FA1. So I hope by the end of the session that you'll be able to answer or understand what control accounts are. A business will undertake some transactions, and these transactions will be recorded in the books of prime entry. At the end of a certain period, these totals in the books of prime entry are then posted to the nominal ledger using double entry to give a summary of the source documents which have been recorded in the books of prime entry. The nominal ledger contains three ledger accounts which are affected when a business sells on credit. So when a sale is made, the sales account will be affected. The trade receivable, which shows the amount owed by the customers at any particular point in time, will be opened, and balances in this trade receivables will be cleared through the bank when the payment has been made. The trade receivables is also called the receivables ledger control account, abbreviated RLCA. In order for a business to chase overdue debts, it must know how much each individual customer owes the business at a particular point in time. However, the balances in the RLCA will be summary balances. So if a company needs to determine how much an individual customer owes, they'll have to go back to the books of prime entry to extract this information, which can be very time consuming. So instead, the company will keep a memorandum ledger for each individual customer, which shows the invoices posted to that customer's account, the cash received, and any balances still outstanding to be paid by the customer. This memorandum ledger is called a receivable ledger. So, to summarize these entries, these ledger accounts, we have a receivable ledger control account, which records all the totals of all credit customers. The opposite of this one is the payables ledger control account, which records the total of all the amounts your business owes your suppliers. Then we do have the two memorandum ledgers, the receivable ledger which has the balances owed by each individual credit customer, and the payable ledger, which has the balances owed by each individual credit supplier. The information in the receivable ledger control account and the receivable ledger is posted from the same source document. So therefore these two accounts, they should balance as long as there are no errors. Similarly, the balance on the payable ledger control account should also balance with the payable ledger. If the balances do not agree on these control accounts in the memorandum ledger, then an error somewhere down the line could have been made. So to find this error, then an entity will have to perform a control account reconciliation. We will look at reconciliation at some point later in the study. But there will be other entries which a business must also ensure that any transactions recorded in the receivable ledger control account or the payable ledger control account are also reflected in the memorandum ledger. One such example is the contra account. Sometimes a business may have a customer which also supplies the business with goods. In our illustration, we have Pico, which is a printing business which sells stationery to FCO, who is a florist. FCO supplies Pico with flowers and plants for their offices. During October, Pico sells stationery worth $200 to FCO, and FCO delivers flowers to Pico worth $70. Pico has the following amounts in their books. So Pico is going to indicate a receivable of $200, but they'll also be owing $70, which will be shown in their payable accounts. The two companies may agree to offset the balances on the receivable and payable via a contra account. The contra would be for the lower amount, in this case the $70. Once the $70 has been knocked off from the $200, the receivable will now be showing a balance of $130, but the payables will be showing a balance of nil. So the contra entry is the $70, which should be entered both in the payables ledger control account as a debit and a credit to the receivable ledger control account. This contra should also be entered in the memorandum ledgers to ensure again that the memorandum ledgers, they do balance with the control accounts. We now move to returns, credit notes, and refunds. You may buy goods or you may sell goods. If you buy, you may return those goods for one reason or the other, or if you sold goods, the customer may return those goods for one reason or the other. So initially when you sold the goods, if you have sold the goods on credit, you would have recorded in the receivable ledger control account a debit of $250 to show that the customer is owing you $250, and then you would have recorded a sale of $250. Then at some point the customer pays you for those goods. So you clear the debit on the receivable ledger control account by crediting the receivable ledger control account with the $250, Then you acknowledge receipt of the cash by debiting the 250 in the bank. So at this point, the balance on the receivable ledger control account will be showing a new balance since your customer has offset what they're owing. However, for some reason or the other, the customer may return those goods, and if they do return the goods, on your end, you issue a credit note, which you send to the customer. So the credit note which you issue, you're going to record it in the sales returns. So if, in our earlier example, if the goods returned, the customer returned all the goods for 250, so you debit sales returns with 250 and you credit the receivable ledger control account 250. Notice now that the receivable ledger control account, which usually has a debit balance, is showing a credit balance. This is because you reversed the original sale and you are now owing the customer pending you refunding the customer. Once the refund has been made, then the receivable ledger control account will be debited to clear off that credit, and the bank will be credited to show that money has left the entity being paid out to the customer for the refund. Again, we get back to the point where the receivable ledger control account is new, having offset the reversed sale with the refund of the 250. Again, the memorandum ledger must also be updated with this transaction. You may have a situation where a customer overpays you for one reason or the other, because they've made a mistake, they've paid one invoice twice. In this case, you'll be owing the customer until you refund the customer for the duplicate payment. This duplicate receipt you've received may be treated like a credit note until you've refunded the customer the funds. There will be times again when a customer has taken too long to settle their invoice, and if there is a condition that when the accounts are overdue for a certain period, you charge interest on that customer, then that interest which you charge the customer, before the customer settles that interest, you will debit the receivable ledger control account and you credit interest receivable. The interest receivable will be a credit on the income statement. We move on to discounts.